Brad Williams, Frugal Finance. Interest rate immunization with swaps. We now turn to an application of swaps to manage the duration of ongoing business operation. Consider FSF, a financial service firm with a stylized balance sheet shown in 22.4. All dollar values are market values. Most assets held are amortizing loans with 10-year average maturity. On the liability side, FSF relies largely on money market obligations and an FRN issue with a 5-year maturity. FSF has also issued a coupon bond that has 10 years remaining until maturity. We have cash, marketable securities on the asset side, and amortizing loans, which represent the majority of assets. Liabilities, considerable money market funds. FRN represents about 20%, and then coupon bond, another 20% of the portfolio. The interest risk of a company. The interest rate risk of FSF can be analyzed by using duration. Most of the balance sheet items have a duration that is evident and requires no computation. Cash has a duration of 0 years. The marketable securities and 6-month money market obligations are zero coupon instruments that mature in 6 months. So their duration is 1/2. The duration of the FRN is also 1/2 year because it has annual payments. This leaves the amortizing loan on the asset side and the coupon bond on the liability side with durations that require computation. Table 22.5 presents detailed computations of the durations for the amortizing loan, asset, item C, and the coupon bond, liability, item F. From the balance sheet for FSF, the amortizing loan throws off $9.6 million per semi-annual period for a market value of $130,467,000. The duration of these loans is 9.209 semi-annual periods, or 4.6 years. The coupon bond has a market value of $24 million and a duration of 14.9 semi-annual periods, or 7.45 years. So here we have our cash flows, our present value. So we're looking at summing this information up, and then we determine, based on the asset side, a weighted PV to calculate duration. Then we have the coupon on the semi-annual bond. Here is the present value and the duration. Table 22.6 summarizes the market value and duration of the balance sheet items. Based on the information, we can compute the duration of the asset and liabilities. The duration are weighted average of the duration of the individual items, weighted by the fraction of assets or liabilities, letting D of A represent the duration of the assets and DL, the duration of the liabilities. We have, I'm going to use this information here, 7 million divided by 155 times 0. In other words, we can go all the way back up here, take this, duration 0, take this, duration, take this, and duration. So we have 7 million divided by 155 times 0, 18, 155 times 0.5, 130 divided by 155 times 4.6, which is this duration here, gives us 3.9220 on a semi-annual basis. D of L, we're going to do the exact same thing, coming up with 1.7. Sorry, I don't know if I'm blocking that out or not with my image. So here, all we're doing is going back up here, using this duration information and computing the overall duration. Brad Williams, Frugal Finance. See you soon.